A credit score is a 3-digit number that identifies how risky you are to a lender. The higher your credit score, the more likely you are to obtain credit and receive the best interest rate. This is important because over the course of a higher interest loan, you will pay hundreds, even thousands of extra dollars just because your credit score is lower than the next guy's credit score. Learning and talking about credit is the best way to understand the power of good credit. We are going to talk about the basics. How is credit scored? Bad credit ranges from 300 to 629, and it can be difficult to qualify for credit in this range. If you fall into the fair credit range, which is 630 to 689, this means that there are more options to qualify for credit, but most likely at a higher interest rate. Good credit ranges from 690 to 719, and this score will offer more choices for credit at lower interest rates. Now, excellent credit is a score of 720 and up. This provides you access to the highest level of credit at the lowest interest rate offered. A credit score is calculated based on 5 specific factors. Payment history makes up the majority at 35% of your total score. Lenders look at whether you've paid past credit accounts on time, including utilities, credit cards, bank loans, and more. Payment history helps a lender figure out the amount of risk you are for future credit. Amount owed makes up 30% of your credit score. Having credit accounts and owing money on them does not necessarily mean you are a high-risk borrower. However, if you are using a lot of available credit, this may indicate that you are overextended, and banks can interpret this to mean that you are at a high risk of defaulting on your payments. Credit history makes up 15% of your credit score and takes into account how long your credit accounts have been established and how long it has been since you've used certain accounts. In general, the longer your credit history, the more it will increase your credit score. Now, even new credit makes up 10% of your credit score. Lenders consider that opening several credit accounts in a short amount of time represents a greater risk, especially for people who don't have a long credit history. If you can avoid it, try not to open too many accounts at once. Your credit mix makes up the last 10% of your credit score and refers to different types of credit you are using, including credit cards, retail accounts, installment loans, or a mortgage. While you don't need one of each type of credit, how well you use them is super important. The most important thing you can do to improve your credit score is to pay your bills on time. A couple of other things you can do include keeping monthly balances on credit cards low, as this will decrease the amount of credit you are using and improve your debt ratio. If possible, pay your credit balances each month so that you don't have added interest and fees to worry about. Don't open too many new cards at one time, as this will trigger numerous inquiries on your credit report, and that can lower your credit score. We hope that you find this conversation about credit score helpful. Join us at MFF as we continue to talk about how to save, invest, and grow your money.